Hey, this is Ken Finnan, also known as a Series 7 Whisperer, and my job is to get you past the SIE exam, the Series 7 exam, Series 65, all the FINRA and NASA exams. So going forward, I'm going to be going a mix of like short little videos, long ones, maybe some podcasts about like interviewing some people who took the tests. But a lot of these are going to be where I use a external source to create a script and then I have somebody else read it because I stumble and mutter a lot. And I think these are working really well. So let's get into it and we're going to have some fun here. And before we get into it, let's talk about one thing. I do live Q&As every Tuesday night for the FINRA exams and every Thursday night for the NASA exams, 8 p.m. Eastern on YouTube. Come have fun, ask questions about whatever you want, celebrate the wins, commiserate with the losses, but meet me every Tuesday night for FINRA stuff, every Thursday night for NASA stuff live on the two of you, and we can get this done, baby. Let's go.
Have you ever looked at a corporate financial report and just felt like, you're trying to read a foreign language?
Oh, absolutely. It's incredibly intimidating for most people.
Right. Like it's just walls of number. But then I think back to the year 2000, Enron reported over, I think it was $100 billion in revenue.
Yeah, over $100 billion. It was massive.
Their income statement looked like a rocket ship. I mean, they were the darling of Wall Street, widely considered like the most innovative company in America.
Everybody loved them until they didn't.
Exactly. Less than a year later, they were completely bankrupt. Their stock was essentially worthless, and thousands of people just lost their life savings.
It's the ultimate cautionary tale.
It really is. So if you're listening to this, you might be wondering, how does a company making billions of dollars on paper suddenly vanish into thin air?
Well, the answer to that question, and really the key to ensuring you never get fooled by a mirage like that, is hidden in the very documents we are decoding today.
And that is the mission of our deep dive today. We're going to decode the fundamental language of corporate financial data analysis.
Strip away all the jargon.
Yeah, look past the terrifying spreadsheets and figure out how businesses actually work on paper. Because you spend your life analyzing these documents, right?
I do, yeah. Tearing them apart to see what companies are, trying to hide or what they're proud of.
I want to learn how to do that. I want to be the student today and understand the mechanics under the hood. We're going to look at the balance sheet, the income statement, and the cash flow statement.
We can absolutely do that because my job isn't to be some human calculator.
Right.
My job is to look at the numbers and deduce whether the underlying business engine is actually sound or if management is just legally massaging the figures to buy themselves another quarter.
Okay, let's unpack this. Before we get into the specific financial statements, I really want to understand the analyst's toolkit.
The context, essentially.
Exactly. Because nobody just opens up an annual report and reads it in a vacuum. You evaluate companies using statistical analyses, right? You look at comparable companies, particular industry sectors.
Yeah, you have to. Establishing context is, without a doubt, the single most important step.
But how do you even begin to do that? I mean, you build these massive proprietary financial models. How do you set that baseline?
Well, analyzing a company in a vacuum is how you get wiped out. Let's say I tell you a company has a 10% operating profit margin.
Okay.
The immediate human reaction is to ask, well, is that good or bad? But the number means absolutely nothing until you establish the neighborhood the company lives in.
Give me an example.
Sure. If you are analyzing a grocery store chain, a 10% profit margin is astronomically good.
Really? 10%?
Oh, yeah. Grocery is a notoriously low-margin, high-volume industry sector. I mean, they make pennies on every apple, but they sell millions of apples.
Right. But if I'm looking at like a software as a service company, a SaaS business, a 10% margin sounds terrible.
Precisely. It's the exact opposite of a grocery store. Their cost to distribute another copy of their software is basically zero.
Right. So what should their margins be?
A mature SaaS company should be operating at, 60, 70, or even 80% gross margins.
Wow.
So an analyst's very first step is gathering the data on comparable companies within that particular industry sector. We aren't just looking at the target company.
We're looking at their competitors.
Exactly. We download the financial data for their 5 closest competitors. We calculate their margins, their growth rates, their debt levels.
Which creates your baseline.
Right. If our target company is suddenly reporting numbers that wildly deviate from that industry standard, well, that's our first investigative thread.
That makes me think of scouting in professional sports.
How so?
If you're a scout evaluating a player, you don't just clock someone's running speed at 20 miles per hour and immediately grab them. You have to compare it to the league average for their specific position.
Oh, that's a great analogy.
Like, a 20-mile-per-hour sprint is generationally fast for a 300-pound defensive lineman. But it might just be average for a lightweight wide receiver. The position dictates whether the data point is actually impressive.
That is a highly accurate way to look at it.
Yeah.
Well, we don't just compare them to their peers today. We use statistical analyses to compare the company to its own past, too.
To see if they're improving.
Exactly. Is that 20-mile-per-hour sprint a one-off fluke because they had a tailwind, or is it a consistent, repeatable trend over the last 3 seasons?
So you tracked revenue, expenses, debt over, what, 5 or 10 years?
Yeah, 5 to 10 years is standard to see the real trajectory.
Let me push back a little on these proprietary financial models you mentioned.
Okay, so for it.
It sounds incredibly sophisticated, but aren't these models often just feeding numbers into a black box?
A black box?
Yeah, like some Wall Street firm creates an algorithm, types in the revenue, assumes a growth rate, and it just magically spits out a buy or sell rating. It feels very detached from the messy reality of running a business.
Well, the finance industry certainly loves to cultivate that mystique, but the reality of a proprietary model is far more grounded than that.
So it's not a magic algorithm.
Not at all. It is simply a highly customized, extremely rigorous application of basic financial accounting concepts. Most often, we're building what is called a discounted cash flow model, or a DCF.
Okay, what is the actual mechanism of a DCF? Like, simply.
At its core, a DCF model projects how much literal cash the business is going to generate over the next 5 to 10 years.
Not accounting profit, but actual cash.
Right, actual cash. Then, because a dollar today is worth more than a dollar 10 years from now, the model discounts all that future cash back to its present value.
Using, like, an interest rate.
Exactly. Every major firm has their own way of structuring these spreadsheets, their own specific ratios they track, and their own proprietary discount rates based on how they assess risk.
So that's the proprietary part.
Yes,
Okay.
that is what makes them proprietary.
But wait, that means the model is entirely dependent on the analyst's assumptions, doesn't it?
It absolutely does.
So if you assume the company grows at 10% a year instead of 5%, the black box spits out a massively different valuation.
You've hit on an important question about the limits of quantitative analysis. The model is just a tool to organize the data.
It doesn't give you the why.
Right. The spreadsheet cannot tell you why a number changed, and it certainly can't predict the future with certainty. The analyst still has to use human judgment to interpret the signals.
Give me a real-world example of that.
Sure. Let's say the model shows a sudden, massive spike in short-term debt. The spreadsheet just recalculates the interest expense. It doesn't care why.
But you have to care.
Exactly. I have to stop and ask, what does this management decision signal? Are they borrowing money because their core business is failing and they're desperately trying to make payroll?
Which would be a huge red flag.
Massive. Or are they borrowing because they spotted a brief window to acquire a competitor at a steep discount?
So the model processes the math, but the analyst translates the strategy.
Perfectly said. The model lays out the board, but you have to figure out what game management is actually playing.
I love that. So to build these models and run these comparable analyses, you have to pull the raw data. And the first massive pillar of that data is the balance sheet.
Yes, the balance sheet is the absolute foundation.
So how do you conceptualize it for a beginner?
The best way to think about it is as a snapshot. It is a photograph of the company's financial health frozen at a single specific millisecond in time.
Like midnight on December 31st.
Exactly. Or the very last day of a financial quarter. It doesn't tell you the story of the whole year.
It just tells you the exact state of affairs on that one day.
Right. It lists the assets, which is everything the company owns. It lists the liabilities, which is everything the company owes to other people.
And then stockholders' equity, which is the net worth left over for the owners.
That is the fundamental accounting equation, and it is ironclad. Assets always equal liabilities plus equity.
Or, to flip it around to make more logical sense for people like me, assets minus liabilities equals equity.
Exactly. If a company sold off every single thing it owned for cash today and used that cash to pay off every single debt it owed today.
The equity is the pile of cash that would be left sitting on the table.
Precisely. Let's break down the actual components, starting with what the company owns. The assets.
Okay, and these are divided into current and non-current assets. Our sources list current assets as cash, cash equivalents, marketable securities, inventory, and accounts receivable.
Yep, That's the standard list.
So if we assume the word current means right now, these are things the company can use to pay the rent tomorrow, right?
Essentially, yes. In corporate accounting, the word current has a very strict, legally defined meaning. It's an asset that is expected to be converted into cash, sold, or consumed within 12 months.
So a one-year window is the dividing line.
Right. Cash is obviously cash. Cash equivalents and marketable securities are instruments like short-term treasury bills or commercial paper.
Highly liquid stuff.
Exactly. They are ultra-safe places where a corporate treasury department parks its excess cash to earn a little bit of yield. But they can be liquidated into actual cash in a matter of days if needed.
And then inventory makes total sense. Like if you are a hardware store, your inventory is the aisles of hammers and nails.
And you expect to sell those within the year.
Right. But I want to talk about accounts receivable, because this is basically a ledger of IOUs, isn't it? Customers who have bought the product but haven't actually paid for it yet.
Yes. In business-to-business transactions, nobody really pays with a credit card at the loading dock. They buy on trade credit.
Like a net 30 kind of thing.
Exactly. A semiconductor manufacturer ships microchips to a computer company, and they include an invoice with terms like net 30 or net 60.
Meaning the buyer has 30 or 60 days to send the cash.
Right. And until that cash arrives, the seller records the value of those chips as an account receivable. It is a highly valuable asset because it represents a legally binding claim to future cash.
But this is where the snapshot nature of the balance sheet seems really ripe for analysis.
How so?
If I'm an analyst, I don't just look at the total number of accounts receivable. I want to know how long it takes to collect that money.
Right.
Like, if their accounts receivable suddenly spikes compared to the previous quarter, that could mean they're selling more stuff. But couldn't it also mean their customers are suddenly refusing to pay them?
Now you are thinking exactly like an analyst. That's a huge thing we look for.
So how do you track that?
We track a metric called Days Sales Outstanding, or DSO. It calculates exactly how many days, on average, it takes a company to collect its cash after a sale.
Okay, so if a company's historical DSO is 30 days,
And suddenly it jumps to 45 days, that is a glaring red flag.
because it means their customers might be facing financial trouble.
Exactly. They're delaying payments. Or even worse, it might mean the company's sales team is desperate to hit their quarterly revenue targets.
Oh, so they're offering ridiculously generous credit terms just to get the product out the door.
Yes, to completely unqualified buyers. The balance sheet exposes the quality of the sales, not just the quantity.
That makes so much sense. Okay, so that's the current stuff. The non-current assets are the long-term engines of the business.
Right, like property, plant, and equipment, or PP&E.
So heavy machinery, fulfillment centers, delivery fleets.
Corporate headquarters, yeah. You don't buy a factory expecting to liquidate it for cash in 6 months. You buy it to generate value for 30 years.
Correct. And while physical assets are straightforward, the balance sheet also requires us to value things you cannot physically touch.
Ah, yes. Intangibles and goodwill.
I am so glad you brought this up. How on earth is goodwill an asset? I mean, I understand how a patent or a trademark is an intangible asset.
Right, they have clear value.
Yeah, like the patent on a blockbuster cancer drug guarantees a monopoly on cash flow for a decade. The Nike swoosh has quantifiable brand value. But goodwill, you can't deposit a good reputation into a bank account.
What's fascinating here is how the mechanics of corporate acquisitions actually force the creation of goodwill.
So it's not just a vague feeling of brand positivity.
No, not at all. In accounting, goodwill only ever comes into existence during a merger or an acquisition. It is a strictly calculated mathematical plug.
Wait, a plug, like just a placeholder to make the math work.
Exactly that. Let's look at one of the most famous examples in corporate history, the AOL-Time Warner merger back in 2001.
Oh, wow. Yeah.
So, at the height of the dot-com bubble, AOL decided to buy Time Warner. Now, if you looked at Time Warner's balance sheet, the fair market value of all their physical assets...
Their cable networks, studios, equipment.
Right. If you take all that, minus their liabilities, it gave them a specific net tangible value. Let's simplify and say all that physical stuff was worth $20 billion.
Okay, $20 billion.
But AOL didn't pay $20 billion because of the hype, the perceived synergies, the subscriber base. AOL paid vastly more than the fair value of the physical assets.
They paid a massive premium.
A huge premium. But remember the fundamental accounting equation. Assets must equal liabilities plus equity. If AOL spends $50 billion in cash and stock to acquire only $20 billion worth of physical assets, The balance sheet is suddenly out of balance by $30 billion.
And that money didn't just vanish.
Exactly. So accounting rules dictate that the $30 billion premium is recorded on the combined balance sheet as a new non-current asset called goodwill.
So goodwill is literally just a permanent receipt showing how much a company overpaid for an acquisition above the value of the hard assets.
Yes. It represents the supposed value of the brand, the customer loyalty, the management team, and all those future synergies.
But wait, what if those synergies don't happen?
And here's the critical analytical mechanism. Goodwill has to be tested for impairment every single year.
Impairment.
Yeah. If an analyst looks at that balance sheet 5 years later and the acquisition has been a total disaster, which the AOL-Time Warner merger famously was,
Yeah, historically bad.
the company is forced to admit that the goodwill isn't actually worth $30 billion anymore.
Because the synergies never materialized and the brand loyalty evaporated.
Exactly. So they have to write it down. In 2002, AOL-Time Warner had to take a goodwill impairment charge of nearly $99 billion.
$99 billion. That's insane.
It was one of the largest corporate write-offs in history. So an analyst looking at a balance sheet heavy with goodwill knows they're looking at historical optimism.
It is an asset built on a promise.
And if the business environment changes, that asset can vanish overnight, completely decimating the company's equity.
That is a terrifying mechanism, honestly. Let's move on to the other non-current assets mentioned. Deferred assets.
Okay.
A deferred asset sounds like a contradiction. I mean, if something is deferred, it's put off until later. How is that an asset I own today?
Think of it this way. The most common type of deferred asset is a prepaid expense.
Like paying rent in advance.
Exactly. Imagine a company pays its annual corporate insurance premium of $12 million entirely upfront on January 1st. On January 2nd, they haven't actually used that insurance yet, but they have a legal right to 12 months of coverage.
Right, because they already paid for it.
Because they have already paid for a future economic benefit, it is recorded as a deferred asset. As each month passes, $1 million of that asset is moved off the balance sheet and recognized as an expense.
Got it. Okay, so that covers the asset side of the equation. Let's look at the liabilities, the things the company owes.
Like assets, these are divided into current and long-term.
Current liabilities include accounts payable, short-term debt, and accruals. So accounts payable is just the exact mirror image of accounts receivable, right?
Yes. When that computer company receives those microchips from the semiconductor manufacturer, they record the chips as inventory.
But they also record an account payable, acknowledging they owe the manufacturer cash within 30 days.
Exactly. And just like you track days sales outstanding to see if customers are paying quickly, you must track days payable outstanding, or DPO, to see how quickly the company pays its own bills.
And I imagine managing that is pretty important.
Oh, if we connect this to the bigger picture of corporate strategy, managing accounts payable is a massive source of hidden value.
How so?
Take a company like Apple. Apple has such immense leverage over its suppliers that it can demand incredibly long payment terms.
Like they don't have to pay for months.
Right. They might collect cash from a consumer buying an iPhone today, but they might not pay the supplier who made the iPhone screen for another 90 days.
Wow.
They are operating with negative working capital. They are essentially using their suppliers as a free, short-term lending facility.
So they get the cash on day one, and they can invest that cash and earn interest on it for 3 months before they finally have to pay the bill. That is brilliant.
It is brilliant, and it shows up clearly on the balance sheet if you know where to look. Now, you also mentioned accruals as a current liability.
Yes, what exactly is an accrued liability?
Accruals are expenses a company has incurred through its operations but hasn't actually received an invoice for or paid cash for yet.
Like what?
The classic example is employee wages. If the balance sheet snapshot is taken on a Wednesday, but the biweekly payroll doesn't go out until Friday, the employees have legally earned those 3 days of wages.
The company owes them that money.
Right. The company accrues that liability to ensure the snapshot perfectly reflects their obligations at that exact millisecond, regardless of when the cash actually leaves the bank.
Makes sense. And then we have the long-term liabilities. Long-term debt is obvious. Those are the 30-year corporate bonds issued to build a new factory or massive bank loans.
Yep.
But there's also deferred liabilities. If a deferred asset is a prepaid expense, what is a deferred liability?
The most important deferred liability to understand, especially in the modern economy, is unearned revenue. also known as deferred revenue.
Okay.
And ironically, for software company, seeing massive growth in this liability is actually a wildly bullish signal for investors.
Wait, if it's a liability, something they owe, how can it be a good sign? That sounds backwards.
Think about how you buy an annual software subscription. You pay the company $1,000 up front in January for 12 months of access.
Great, I do that all the time.
From the company's perspective, they just collected $1,000 in cash. But accounting rules are very strict. You cannot recognize revenue until you have actually delivered the service.
Oh, because on January 2nd, they haven't provided me a year of software yet.
Exactly. They owe you 11 months and 29 days of service.
So they record the cash as an asset, but they have to balance it by recording an equal liability called unearned revenue, representing their obligation to provide the software.
You got it. As the year progresses, month by month, they slowly drain that deferred liability and recognize it as actual revenue.
So analysts love seeing deferred revenue grow because it represents guaranteed, locked-in future revenue where the cash has already been collected.
Yes. It is a liability, but it's a liability that will be settled by providing a low-cost service, not by paying out cash.
That perfectly illustrates why you can't just look at the total liabilities number and assume debt is bad. You have to unpack what the liability actually represents.
Exactly.
Okay, so we've covered the assets and the liabilities. The final section of the balance sheet is stockholders' equity, the net worth.
Right.
Our sources list: preferred stock, common stock, additional paid-in capital, retained earnings, and capital surplus. Let's untangle these. Common stock is what everyday retail investors buy and sell on the open market, right?
Yes. Common stock represents the residual ownership of the company.
Residual meaning what's left over.
Right. If the company goes bankrupt, the common stockholders are the very last people in line to get whatever pennies are left after the banks, the bondholders, and the suppliers are paid off.
So it's the riskiest.
It carries the highest risk, but also the highest potential reward because common stockholders have voting rights and benefit the most from long-term growth.
So what is preferred stock? I see this line item occasionally, and it seems to act differently.
Preferred stock is a fascinating instrument because it acts like a hybrid between equity and debt.
How so?
It is technically equity, but it usually doesn't come with voting rights. Instead, it pays a fixed, guaranteed dividend, much like the interest payment on a bond.
Oh, I see.
And crucially, in the event of bankruptcy or liquidation, preferred stockholders have seniority over common stockholders. They get paid first.
So it's safer for the investor.
Yes, but analysts have to look at preferred stock carefully because those guaranteed dividend payments act like a fixed cost that drains cash before the common stockholders ever see a dime.
Okay, that makes sense. Now, what about additional paid-in capital and capital surplus? These terms sound basically identical.
They are essentially the same concept, just different terminology. When a company issues stock to the public during an IPO, the stock usually has a meaningless, legally required par value assigned to it.
Like 1 penny per share.
Exactly. But the public market might be willing to pay $50 for that share. The 1 penny goes into the common stock line item, and the remaining $49.99 goes into the additional paid-in capital or capital surplus account.
So it simply represents the total cash premium investors handed to the company above the nominal par value when the shares were originally created.
That's all it is. It's a historical record of the money raised from the capital markets.
But the most important equity line item for analyzing the actual business over time has to be retained earnings.
Without question. Retained earnings is the ultimate historical scorecard of management's competence.
Why is that?
Every single year, when a company generates a net income profit, the board of directors has a choice. They can distribute that profit to the shareholders as a cash dividend, or they can retain the profit and keep it inside the company to reinvest in growth.
Like to build new facilities, fund R&D, or pay down debt.
Exactly. So retained earnings is the cumulative running total of all the profit the company has ever made since the day it was founded, minus every dividend it has ever paid out.
Wow. So a steadily growing retained earnings balance proves that the company's business model works.
It proves they consistently survive the gauntlet of the market and that management is successfully compounding the value of the enterprise.
But you just hit on a key phrase there, surviving the gauntlet. The balance sheet just shows us the snapshot of that retained profit at the end of the year.
Right.
It doesn't tell us how brutal the journey was to get there. To see the gauntlet, we have to transition to the second document.
The income statement.
Yes. If the balance sheet is a freeze-frame photograph, The income statement is a movie.
I like that.
It shows what happened over a period of time, like a whole quarter or a whole fiscal year. It creates a narrative arc, starting from the massive, optimistic top line of revenue and moving all the way down through a series of grueling steps to reach the final net income.
The gauntlet is a perfect metaphor. A single dollar of revenue enters the top of the income statement, and immediately, various internal departments, external suppliers, creditors, and the government all try to take a piece of it.
And financial analysis is just the study of how much of that dollar actually survives the journey to the bottom
Yes,
line.
that's exactly what it is.
Let's walk through that specific sequence. It starts with revenue or sales.
Yeah.
This is the gross total of everything the company sold. If they sold 1 million shoes for $100 each, the revenue is $100 million.
Right. But revenue is vanity. The first major hurdle that dollar has to clear is the cost of goods sold, or COGS.
What's included in COGS?
COGS represents the direct, unavoidable physical costs of manufacturing the specific item you sold. For a shoe company, COGS is the leather, the rubber soles, the shoelaces, and the hourly wages of the factory workers cutting and stitching the materials on the assembly line.
Because if you don't spend that money, you physically do not have a shoe to sell. This is where we have to analyze fixed versus variable costs. During economic turbulence, understanding this mix is vital. Let's use two modern business models to contrast this. Netflix versus Uber.
Oh, that is an excellent comparison to understand operating leverage. Let's do it.
So Netflix is a business built almost entirely on fixed costs. They spend billions of dollars upfront producing a season of Stranger Things, and they spend millions maintaining their server infrastructure.
Right.
It doesn't matter if 10 people watch the show or 10 million people watch it. The cost to produce it was fixed.
Exactly. And in a booming economy, a high fixed cost structure is incredibly powerful. Once Netflix covers its massive fixed costs for the year, every new subscriber that signs up is almost 100% pure profit.
Because the variable cost of streaming the data to one more household is like fractions of a penny.
Right. Their profit margins expand exponentially as revenue grows. This is called high operating leverage.
But the danger of high fixed costs is what happens in a recession.
Yep.
If consumers cancel their subscriptions, Netflix's revenue plummets, but their fixed costs, the studio contracts, the server leases, don't change.
So their profit gets wiped out instantly. Now contrast that with Uber.
Uber has a high variable cost structure.
Yes. The primary cost of delivering a ride is the payout to the independent driver and the variable insurance cost for that specific trip.
So if I request a ride, Uber incurs a cost. If I don't request a ride, Uber doesn't pay a ever.
Exactly. So in a recession, if ride requests drop by 50%, Uber's revenue drops by 50%, but their massive driver expenses also automatically drop by 50%.
A variable cost structure naturally protects the downside. The company shrinks gracefully.
Yes, but the trade-off is that in a boom, they don't get the massive exponential profit explosion that Netflix does, because every new ride they sell inherently requires paying another driver.
So when analysts tear apart the COGS section of the income statement, they're desperately trying to calculate this fixed-to-variable ratio to model how the company will perform if the macroeconomic weather suddenly changes.
That is exactly what we are doing.
Okay, so revenue minus COGS gives us our gross profit. But we are only partway through the gauntlet. The next massive hurdle is selling, general, and administrative expenses. SG&A, this is the corporate overhead, right?
Yes. If COGS is the assembly line, SG&A is the corporate headquarters.
What goes in there?
It includes the CEO's multi-million-dollar salary, the global marketing budget, the human resources department, the legal fees, the software subscriptions for the sales team.
So expenses required to operate the business,
Mm-hmm.
but not directly tied to stitching the leather of the shoe.
Right. And I imagine SG&A is where analysts look for bloat.
Absolutely.
If a company's revenue is growing at 5% a year, but their SG&A expenses are growing at 15% a year, an analyst will rip that management team apart on the quarterly earnings call.
Because it means management is building a bloated corporate empire.
Exactly. Hiring too many middle managers, flying first class, throwing lavish offsite retreats without actually generating commensurate sales growth.
But could a spike in SG&A be a good thing?
Sometimes, yes. It might be a calculated strategy. A software startup might deliberately run massive losses in SG&A by hiring a giant sales force to aggressively capture market share.
Sacrificing short-term profit for long-term dominance.
Right. Again, the numbers reveal the symptom. The analyst diagnoses the strategy.
Following SG&A, the income statement introduces expenses that don't seem to involve writing a check right now. Amortization, depreciation, and depletion. We talked about property, plant, and equipment on the balance sheet. Say a company buys a massive $1 million industrial tractor that will last for 10 years.
Right. The fundamental concept here is the matching principle.
What's that?
If a company spends $1 million cash today for a tractor that will generate revenue for a decade, it would be severely misleading to record a $1 million expense on this year's income statement.
Because it would make this year look artificially terrible, and the next 9 years look artificially highly profitable.
Exactly, because the tractor is helping the business run over that entire 10-year period. So accounting rules dictate that we capitalize the $1 million as an asset on the balance sheet, and then we slowly depreciate it.
Meaning you recognize a $100,000 depreciation expense on the income statement every year for 10 years.
Yes. Depreciation is simply the systematic recognition of a physical asset wearing out over time.
And amortization?
Amortization is the exact same mechanism applied to intangible assets, like a patent slowly losing its value as it approaches its expiration date.
Got it. And depletion?
Depletion is the term used for natural resources, like an oil company recognizing the cost of extracting barrels of oil from a finite reserve.
Let me stop you there, because this is where the mechanics can get confusing.
Sure.
Does taking a $100,000 depreciation expense actually affect the company's bank account this year? Did they write a check to depreciation?
No, and that is a crucial insight. Depreciation and amortization are non-cash expenses. The cash left the building years ago when they originally bought the tractor.
So why do it?
The depreciation expense lowers the accounting profit on the income statement, which lowers their tax bill, but it does not represent cash physically leaving the bank today.
That seems really important to remember.
Keep it in mind because it becomes the linchpin when we finally get to the cash flow statement.
Okay, so a dollar comes in as revenue. We subtract the physical costs, COGS, the corporate overhead, SG&A, and the wear and tear on the equipment, depreciation. This gets us to a subtotal called operating income, or EBIT, earnings before interest and taxes.
EBIT.
Why is this specific line item considered the holy grail of the income statement?
Because operating income is the purest mathematical reflection of the core business engine. It tells you whether the fundamental premise of the company actually works.
Right.
If you sell shoes, operating income tells me if you are good at designing, manufacturing, marketing, and distributing shoes efficiently. It strips away all the noise of how the company is financed and what jurisdiction it pays taxes in.
Let me push back on that. Why are interest and taxes considered noise? If I run a business, paying the bank interest on my loan and paying the government taxes are very real expenses. Why separate them from the operations? Why not just judge the management team on the final net income?
Because interest and taxes are external to the operational efficiency of making a shoe. Let's look at interest. The amount of interest a company pays is dictated entirely by its capital structure. The mix of debt and equity management chose to fund the business.
Right.
Imagine two identical shoe companies. Same revenue, same brilliant marketing, same efficient factories. Their operating income will be exactly the same.
Because the core operations are identical.
Right. But Company A was funded entirely by issuing common stock. They have no debt, so their interest expense is zero.
And Company B.
Company B's CEO decided to do a massive leveraged buyout and loaded the balance sheet with high-yield bonds. Company B will have a massive interest expense dragging down their bottom line.
So if an analyst just looked at the final net income, Company A would look like a vastly superior business. But in reality, the core shoe-selling engine of both companies is exactly identical. The only difference is the financing strategy.
Precisely. By looking at operating income, the analyst isolates the operational variables from the financing variables.
And taxes are the same way.
The same logic applies to taxes. The statutory corporate tax rate is dictated by the government. It can change based on political elections. Management cannot control the macro tax rate.
So analysts judge the operational health at the operating income line, and then they assess the financing choices below that line.
Exactly.
That makes total sense. So after we subtract the interest payments to the creditors and the tax payments to the government, we finally arrive at the bottom of the gauntlet. Net income, the bottom line, the final accounting profit.
Yes. Net income is what is left over for the common shareholders. It is the number that feeds directly into the retained earnings account on the balance sheet we discussed earlier, completing the loop.
If net income is positive, the company was profitable under the rules of accrual accounting.
Under the rules of accrual accounting, which leads us perfectly to the third massive pillar.
Because a company can have a massive positive net income, a beautiful narrative arc on the income statement, and still file for bankruptcy the following Tuesday. Right?
Yeah, exactly.
Here's where it gets really interesting. Profit is an accounting fiction. Cash is reality.
Always.
You cannot pay your employees with net income. You cannot pay your suppliers with retained earnings. You can only pay them with cold, hard cash. And that brings us to the ultimate reality check, the cash flow statement.
I love how you frame that.
I think of the cash flow statement like the fuel gauge in a car. The income statement is like the fancy digital dashboard in a modern vehicle. It takes into account your average speed, the wind resistance, the historical fuel efficiency, and it calculates an estimate. Range to empty, 50 miles.
Right, it's an estimate.
It's a sophisticated, smoothed-out projection based on accrual accounting rules. But the cash flow statement, that is physically dipping a stick into the fuel tank. It doesn't care what the computer's estimate says. If the tank is empty, the car's going to stall out and die right there on the highway.
That is a brilliant analogy. Accrual accounting, which governs the income statement, deliberately records economic events when they happen, regardless of when the cash actually moves.
Right.
The cash flow statement's entire purpose is to strip away all the accruals, all the non-cash estimates, and reconcile the accounting profit with the actual physical movement of cash in and out of the corporate checking accounts.
The cash flow statement is broken down into 3 sections: operating cash flow, investing cash flow, and financing cash flow. Let's start with operating.
Yeah.
How does an analyst use this to test the validity of the income statement?
Operating cash flow, or OCF, is the lie detector test for the income statement.
Ooh, I like that.
It answers the fundamental question. Did the day-to-day operations of selling products actually generate physical cash? It starts with the net income number from the bottom of the income statement. Then it systematically adjusts that number.
Adjust it how?
First, we add back all the non-cash expenses, like that depreciation we talked about earlier.
Because taking a depreciation expense lowered our net income, but no cash actually left the building.
Exactly. We have to add that money back to find our true cash position. Then we adjust for changes in working capital, the current assets and current liabilities from the balance sheet.
Walk me through a working capital adjustment. This is where analysts look for earnings quality, right? The red flags.
Exactly. Let's go back to our semiconductor manufacturer. It's late December. The CEO knows they're going to miss their annual revenue targets, which means the executives won't get their bonuses. So they engage in a notorious practice called channel stuffing. They call up their biggest distributors and offer them absurd, unprecedented credit terms. Buy $50 million of microchips today, and you don't have to pay us for an entire year.
And the distributors agree because why not?
Right. The chips are shipped on December 30th.
Under accrual accounting, because the product was delivered, the company gets to record $50 million of revenue on their income statement immediately. The net income skyrockets. The executives hit their targets.
Yes. The income statement looks immaculate. But let's look at the cash flow statement. We start with that massive net income. But then we look at the balance sheet, and we see that accounts receivable, those IOUs, increased by $50 million.
And because an increase in accounts receivable means cash was not collected.
The cash flow rules require us to subtract that $50 million from our operating cash flow.
So even though net income is huge, the operating cash flow might be 0 or even negative.
Precisely. This is the definition of poor earnings quality. When an analyst sees net income diverging wildly from operating cash flow, alarms go off.
It usually means management is using aggressive accounting tricks to recognize revenue early or delaying recognizing expenses.
Exactly. The cash flow statement cuts through the illusion. It forces management to prove that their accounting profit eventually turns into actual cash.
That is a brilliant mechanism.
Yeah.
Okay, the second section is investing cash flow. This seems directly connected to the non-current assets on the balance sheet we discussed, like the factories and equipment.
It is entirely connected. Investing cash flow tracks the physical cash the company spent on long-term assets. The primary metric here is capital expenditures, or CapEx.
Okay.
When that company finally wrote the $1 million check to buy that industrial tractor, it showed up as a massive negative cash outflow in the investing section.
So a negative investing cash flow is actually a good thing. It means the company is growing and building its infrastructure.
Usually, yes. A healthy, growing company should have negative investing cash flow because they are constantly reinvesting their future. building new data centers, upgrading software, buying more efficient machinery.
Do analysts split that up at all?
Yeah, analysts split this into two categories. Growth CapEx, which is spending money to expand the business, and maintenance CapEx, which is the bare minimum spending required just to keep the current factories from falling apart.
Let me guess. If management wants to temporarily manipulate the fuel gauge and make their total cash look better, they just quietly stop spending money on maintenance CapEx.
You are thinking like an activist investor now, yes.
Yeah.
A struggling management team might cancel all the factory maintenance for a year.
So their total cash balance looks great because no cash left the building in the investing section.
But the analyst knows that the physical infrastructure is rotting from the inside out. They are starving the engine to make the dashboard look pretty. The bill will inevitably come due when the equipment fails.
Okay, the final section is financing cash flow. If operating cash flow is from selling the product and investing cash flow is from buying the factories, financing cash flow must be how you interact with the capital markets.
Correct. Financing cash flow connects directly to the long-term liabilities and the stockholders' equity sections of the balance sheet. It tracks the cash flowing between the company and its external investors or creditors.
Okay, so examples.
If the company issues a new block of common stock or takes out a $500 million syndicated bank loan, that creates a massive positive influx of cash in the financing section.
On the flip side, if the company pays a cash dividend to its shareholders or pays down the principal on its debt or buys back its own stock, that shows up as a negative cash outflow in this section.
Yes. And analyzing the interplay between these three cash flow sections reveals the fundamental life cycle of the corporation.
How so?
If you see a company with chronically negative operating cash flow, their core business bleeds cash every single day, but their total cash balance stays stable because their financing cash flow is consistently positive from issuing more and more debt, you are looking at a zombie company.
They're just taking out new credit cards to pay off the old credit cards, hoping the music doesn't stop.
Exactly. They're entirely dependent on the goodwill of the capital markets to survive. The moment interest rates spike or lenders get nervous, the financing cash shuts off, the fuel gauge hits zero, and the company files for bankruptcy.
Wow.
This happens over and over again in the corporate world.
But consider the opposite scenario. A mature, dominant company like Microsoft or Apple. Their operating cash flow is a geyser. They generate tens of billions of dollars in pure cash every quarter from their core operations.
Right.
Their investing cash flow is negative, but they generate far more cash than they could ever profitably reinvest into new factories. So what happens in their financing section?
For a dominant, mature cash cow, the financing section is deeply negative, but for the best possible reasons.
Like stock buybacks.
Yes. Management uses that massive excess cash to aggressively buy back their own stock, reducing the share count and artificially boosting the value of the remaining shares. Or they initiate massive dividend programs, returning that cash directly to the owners.
It really tells a story.
Analyzing a statement of cash flows tells you exactly what phase of the corporate life cycle a business is in: a cash-burning startup, a rapidly scaling disruptor, or a mature cash-printing utility.
It is incredible how tightly woven these documents are. The deeper we go, the more I realize you cannot understand the story by looking at just one page. I want to try to synthesize this entire matrix we've built today.
Please do.
We started with the analyst's toolkit, understanding that numbers are meaningless without industry context, and that proprietary models, like discounted cash flow analyses, are just tools that require human judgment to translate management's strategic intent. Then we looked at the balance sheet. It's the freeze-frame snapshot. It lists the current assets, like accounts receivable, where we can spot desperate sales tactics by tracking days sales outstanding.
Yeah.
It lists the long-term assets, like goodwill, which is a ticking time bomb if an acquisition sours. It lists the liabilities, revealing how companies like Apple manipulate accounts payable to create free leverage. And it ends with retained earnings, the ultimate historical scorecard of compounding value.
That's a perfect summary of the balance sheet.
From there, we entered the gauntlet of the income statement. We saw how revenue is attacked by the physical COGS, where the balance of fixed versus variable costs dictates how a company will survive a recession.
Right.
We saw corporate SG&A overhead, the non-cash illusion of depreciation, and arrived at operating income, the purest measure of the core business, before the external noise of interest and taxes muddy the waters. And finally, we took that accounting narrative and subjected it to the ultimate lie detector, the cash flow statement. We learned how to strip away the accruals to find the true operating cash flow, exposing channel stuffing and poor earnings quality.
It all comes back to cash.
We saw how investing cash flow reveals whether management is starving the engine or building for the future, and how financing cash flow exposes the zombie companies rolling over debt just to stay alive.
When you lay it all out like that, the true elegance of double entry accounting becomes apparent. These three documents form a closed, mathematically perfect loop.
They really do.
The net income from the income statement flows directly into the retained earnings on the balance sheet and simultaneously serves as the starting point for the cash flow statement. You cannot artificially manipulate a number on one document without it leaving a forensic footprint on the others.
It's like a puzzle.
Financial data analysis isn't about doing math. The math is elementary. Financial analysis is the art of translating this interlocking matrix of data back into the messy, chaotic story of human behavior, economic friction, and strategic survival.
So what does this all mean for you, the listener? Once you look past the intimidating jargon, you realize that corporate financial data isn't some abstract theoretical construct hovering in the clouds over Wall Street. It is a direct, quantifiable reflection of the physical world we all interact with every single day.
It touches everything.
Think about the profound butterfly effect of your own behavior. The next time you walk into a store or click Buy Now on an app, you are initiating a cascade of mathematical events. The moment your credit card is approved, you are instantaneously decreasing that company's inventory line on their balance sheet. You are generating top-line revenue on their income statement. You're adding a positive tick to their operating cash flow. And eventually, after surviving the gauntlet of costs, taxes, and depreciation, a microscopic fraction of your specific purchase trickles all the way down to tweak their net income, marginally increasing the retained earnings equity for their shareholders.
It's all connected.
You aren't just a passive consumer moving through the economy. You're an active participant, a real-time data creator, shaping the very numbers that dictate whether a company builds a new factory or files for bankruptcy. The next time you walk into your favorite business, don't just look at the products on the shelves. Look at the building. Look at the employees.
Imagine the machinery behind it.
Exactly. Imagine the unseen financial machinery running silently behind the cash register, endlessly balancing assets and liabilities, calculating the tension between fixed and variable costs, and translating the chaos of human commerce into the pristine, rigid language of financial data. It is a language, and now you know how to read it.